Hey, welcome back. My name is James Johnson. My expertise lies in retirement and estate planning. And today I'm going to talk to you about the tax-free retirement game changer. So what do I mean by game changer? Well, first, understand that you must understand the basics of money. And so I'm going to send you out to play in a pro golf tournament tomorrow. Do you want your favorite golfers swing or do you want their clubs? Well, good, because what we're going to talk about today is we're not going to talk so much about the clubs in the beginning as the swing. What is the important way to play the game? See, there's only three ways to grow your money. The first way you grow your money is taxed as you go. This is cash, savings, certificates of disappointment, bonds, anything that's a 1099 income. Now, the second way to grow your money, and by the way, tax as you go is really the worst way to grow your money because that 1099 at the end of the year every year. So then the next question would be, well, what are the other two ways? And the first way is to grow your money tax deferred. Now, tax deferred means that you're putting the money in before you pay taxes on it. You're getting a tax deduction for that. And then when you go to take the money out, you pay the taxes when you take it out. So you're really not deferring taxes. What you're doing is you're deferring the calculation out to a point in time where you don't know what that rate's going to be. Now, the third way to grow your money, and what most people say is the best way, is tax-free. And we have three ways that we can grow our money tax-free. We can grow it in muni bonds, Roth IRAs, and indexed universal life, or whole life, any time of a maximum funded life insurance policy. Now, it's whether it's something is better or worse when it comes to tax deferred or tax free is totally dependent upon the exit strategy. Because here's the reality. When you put your money in a tax deferred account, most people believe that they're going to be putting it away at a higher tax rate than when they take it out. And if that actually turns out to be true, they actually end up at a lower tax rate when it comes time to take the money out, they win the game. But if they take it out at the same rate or a higher rate when it comes time to take it out, they lose the game. Some quick numbers for you. Currently, we're $33 trillion upside down with a $192 trillion deficit for Social Security, Medicare, and prescription drugs. We'll spend about $1.7 trillion more than we bring in. Highest income taxes have ever been in the United States is 94%, average 56%. Currently, we're sitting at 37%. Everybody I've ever asked believes that taxes will be higher in the future, and certainly no one believes it'll be lower. So if that's in fact true, will you arrive in a lower tax bracket in the future? But let's just say that you believe that you are going to arrive at a lower tax bracket in the future. Then in fact, you should be maximizing those qualified accounts or those tax deferred accounts. And make no mistake, if your employer gives you a match, you should be putting it up to the match. But these days, with the Secure Act and many other changes that happen in the tax laws, you have the ability to put your money not in a tax-deferred account in your 401k, 403b, 457, but put it in a tax-free account. And in many cases, that's the way you should be doing it. But you have a limit as to how much money you can get there. So once you get to that limit, do you want to continue to just put money away over in tax as you go, or do you want to put it in tax-free? And I believe you're going to want to put it in tax-free going forward once you know what your options are. So why is 401k qualified money, why isn't it working? Well, like I just said, most people will end up in the same or higher tax bracket when it comes time to take it out. So they're really going to lose the battle. They're not going to win because they don't have as much money as they believe they have. Because the bottom line is the government is their business partner. Look at it like this. If I was going to write you a check today and I was going to loan you $100,000 today, you would have two questions. You would want to know when you have to pay it back, and you would want to know what that rate was going to be. And in fact, if I told you that you have to pay it back when I said you had to pay it back, and I get to set the rate when the time comes to pay it back, you would never borrow my money. Yet this is exactly what you're doing in your qualified accounts. You're allowing them to tell you when you have to pay it back, and you're allowing them to determine what that tax rate's going to be, unless you become proactive. So when we go out here to invest our money, where is the best place to invest our money? Well, if we were looking for the perfect place to invest our money, I would bet that you would want these things. You'd want it to be no risk. You'd want to have guarantees. You'd want it to be penalty free. You'd want it liquid and be able to use it anytime you want. You'd want it to be protected. You'd like to be able to leverage it. In other words, use it in two places at once. You'd like it to be tax deferred, so pay no taxes on it when you put it in. You'd like it to be tax free, so take it out when you take it out tax free. You'd like to be able to collateralize it, use it to go out and once again leverage it. You'd like it to be tax deductible when you put it in. Maybe you'd want some disability benefits, and maybe you'd want to pass it on tax free. Well, if we take a look at our different investments that most of us are doing, our IRAs, 401ks, etc., what we'll find is that we only have two green boxes there. One, we get to defer the taxes, and two, that we get tax deductibility when we put it in. And we might have some liquidity, but the reality is we probably should not be borrowing from our 401ks, etc. So this is what most of the strategies look like that we're using out there today. And you can see there are very few green boxes. Now, what if we could go out and we could get a strategy? Oh, incidentally, that first strategy we wanted, that's a unicorn, okay? It just simply doesn't exist. But if we could go and get a strategy where we might have some penalties, say we took it out too early, but we couldn't deduct the money that we put in, but we could get all of those other things, that would look pretty good, wouldn't it? Well, that is what's called a maximum funded life insurance policy under the laws of TEFRA, DEFRA, and TAMRA. Now, it's not your typical grandparents' life insurance policy. As a matter of fact, what most people do is they have a term insurance policy. So they buy the most insurance using the least amount of money. And the reality of term insurance is only about 2% of it will ever get paid out. So for most people, it's a rather expensive lottery ticket. Now, the other way that you can buy insurance is you can buy the most insurance but overfund the policy, meaning that you put extra money inside of the policy, and what it does is it grows its cash value so that over time there's enough money in that policy so that what it does is it covers all the cost so that the insurance is permanent, meaning that no matter how old you live to be, the insurance will still be there when it comes time for you to pass away and pass money on to your heirs. Now, there are different types of policies out there. There are whole life, variable life, and universal life, all of which are good products depending upon what you're trying to do. But if you go out here and you buy a maximum funded life insurance policy, the difference is you're going to buy the least amount of insurance using the most amount of money. Now, when we were buying the most amount of insurance using the least amount of money, that rule was set by the insurance company. But when we're buying the least amount of insurance using the most amount of money, that rule is going to be set by the IRS. Now, if we do this and we do this correctly, we get a tax-free death benefit, we get tax-deferred cash value accumulating potential, and tax-free loans on withdrawals. The tax-free death benefit is the main reason why you should buy the insurance. In the event of an early death, the benefit passes to your beneficiaries income tax-free and can be used for anything. Income replacement, supplement college, business succession plans, mortgage and other debts, estate taxes, and other financial needs. Tax-deferred accumulation, your policy cash value has the potential to grow income tax-deferred based on positive changes in the external market index and is guaranteed to never decrease due to market volatility. So this is what's called indexing. And indexing is in an index universal life policy, indexing is referred to how the policy cash value is credited with interest. Rather than earning a fixed rate of interest like a traditional universal life policy or whole life policy, the cash value is linked to the performance of the stock market, such as S&P 500, NASDAQ, Dow, etc. The index serves as a benchmark for the policy cash value to grow. When the index performs well, the policy cash value can increase by a percentage subject to certain caps, floors, and spreads set by the insurance company on an annual basis. If the index performs poorly or sees a negative return, the policy cash value will not decrease below the minimum guaranteed rate of return, which is known as the floor, which is 0. And we like to say that 0 is our hero. When the stock market goes down, we make 0, we lose 0. And I like to ask people, how would you have liked to have made 0 in 2000, 2001, 2002, 2008, and 2022? Would have been a marvelous time, right? So this is how that works. So if you look here in 2000, 2001, 2002, we had 3 years down in the market. And then for most people, it took them 5 years to get back up, head above water, back to where they started from. And then they stepped on their head again. Then it took them another 5 years to get back up. And then they had this long run up of 5 years. And then in 2022, they had another down market. If we put indexing on top of that, you can see during the period of time when the market was down, we didn't make any money and we didn't lose any money. And so we came off of a much higher number and we didn't have to get back to where we were to actually make money in 2008 when the market went down. And you can see here over that period of time between 2000 and 2017, rather than ending up with $181,000 with huge ups in the market, 20, 30%, etc., and using caps and making lesser numbers such as 10 to 15, we came out at $352,271. Now, I don't know about you, but I'll take the top way of doing it every single day. Now, in addition to that, we were able to do that all tax-free, be able to access our money anytime we want, put it back if we want, and we're getting most of the gains, never participate in losses, and if we should die early, we pass it on at 2 to 3 times that amount, 100% tax-free. So, it's more important, in our opinion, to avoid the losses than to pick the winners. Everybody's out trying to make the highest rate of return. And what I try to explain to people all the time is rate of return, although it's important, is not the most important thing. The most important thing is the net return at the end of the day. What is the spendable cash? So tax-free distributions. There are 3 ways to take money out of a life insurance policy. There is the sad way, the dumb way, and the smart way. The sad way is very simple. You die. And when you die, we'll do our very best to get the heirs to look sad when we hand them a check for $1 million. Tax-free. The dumb way is a word. What that word is withdrawal. I would like to withdraw some money. Now, you can withdraw to basis, and basis was the amount of money that you put inside of that life insurance policy. But if you withdraw above basis, you pay ordinary income taxes. So the smart way is to use loans. And it's important to understand that you are not going to borrow your money. You're going to use your money as the collateral capacity to use the insurance company's money. Your loans from the policy cash value are income tax free. The distributions can be used for anything you choose, and no one's going to ask you why or when you need it. They're just going to give you the money because they're always covered. So you can use it for supplement, retirement funding, long-term care needs, college tuition, weddings, vacations, credit card debt, financial emergencies. As a matter of fact, this college planning with the maximum funded life insurance is so much better than 529. It's insane. But most people just don't know and don't take the time to get one set up. Now, as I told you, this is all regulated by the IRS. IRC Section 101A, life insurance death benefit is received federal income tax free. Section 7702, definition of life insurance, provides tax-deferred growth. And 72E, loans from a policy are not considered distributions and thus are generally subject to no income taxes. Ed Slott says the single biggest benefit in the tax code is tax exemption for life insurance. Yet, most people don't have life insurance. They have death insurance. And I can tell you, I have never met a person has utilized this most important asset that they have, and that's their insurability. I was a master lead advisor for Ed Slott for over 9 years. And what I can tell you about Ed is that when it comes to qualified money, IRAs, 401ks, etc., Ed is one of the smartest guys in the country with regards to that matter. And if he's telling you to use life insurance, you probably ought to be listening. So why few understand this? Most financial professionals do not understand how it works or how to properly fund a policy. I see policies all the time that people tell me, oh, I have one of those. And I can look at that policy in about 30 seconds, tell you whether it was done right or not. In most cases, not all, but in most cases, if the death benefit started off with zeros at the end, in other words, it was 250,000, 500,000, a million, etc., it was probably not properly maximum funded. When we're building a maximum funded life insurance policy, we're not looking at the death benefit. We're looking at the amount of money we want to put in that policy over a period of time, and then we're getting our death benefit down to the lowest possible point. So you want to be careful about who designs this for you. Seek an experience and confidence to execute it correctly. This is not a short-term plan. And if it is not your plan to be doing this out of your lifetime, you should not be doing this. You cannot possibly maximum fund a life insurance policy for someone that's young in less than 3 years in one day, and for the average person, 5 years in one day. And most people should be doing it out over their entire life. Ideally, you won't touch this money until you get out to the 11th to the 15th year. So for many people, the exit strategy just is not going to work for you. Now, I want to thank you for taking your time to watch this. I want to encourage you to go below here and subscribe to our YouTube page and take the time to set up a meeting with us. It's no cost, no obligation to find out if what you're doing is actually working and if what you're doing is what you want it to be. Okay? Can you get tax-free out of this? Is there a better way to do it? So remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling and make it a great day.